Talk Tuesday. I'm your host, Karla, and with me today is my fellow co host and CMT, David Blake. It's Monday, January 29th, 2024, and we have some activity to talk about that happened in the stock market last week, along with some interesting things to look out for going forward. We do it from a technical perspective. David, I hope that you had a great weekend. How are you doing today?
I'm doing well. I had a good weekend. Watched a lot of football and we warmed up a little bit here in Atlanta.
Football and staying warm sound like two great things considering how cold it is in a lot of places throughout the US. But let's go ahead and get started and take a look at last week's stock market activity.
All right. Well, the major averages just keep marching higher. Last week we were up again. That's the 12th time in 13 weeks that the Dow and S&P 500 and NASDAQ have closed higher off of that October low. So some pretty impressive gains over that time. And what we're doing, we're looking at, we kind of have I mentioned last Wednesday or Thursday that we're kind of falling into a little bit of a Goldilocks economy where growth is a little bit stronger than expected. Inflation is coming down a little quicker than expected. And then earnings are mostly above estimates. If you issue some forward guidance, your stock is reacting to that. If you come up with and say that guidance isn't going to be so good, then your stock's getting pounded. But in general, I think that we're seeing earnings coming in basically where they hoped they were going to be, and that we're seeing a pickup in activity with the some of the stronger economic data. Went into the last week, the S&P 500 finished up the period with a 5-day record run. Did finish a little bit lower on Friday. We're getting new highs from some of the big cap tech stocks like Microsoft, Nvidia, Alphabet, Meta Platforms, Amazon. They're all punching their own record highs, which is good for the market. These are overweighted securities that as long as they're moving up, the whole market's going to move up. So that's good. We did see a little bit it's hard to say volatility in yields because they basically vacillated between 4.08 and 4.18, and then they settled right around 4.14. That's kind of what where we've been. Of course, we hit 3.80, then it kind of came back to reality a little bit here in January. Now we do have the FOMC meeting begins tomorrow, where the Fed is expected to leave rates alone. And so from there, we'll get an announcement on Wednesday where, again, I'd expected to leave rates alone. And then we're actually kind of, it's kind of a coin toss right now. A lot of investors were expecting a March rate cut to come out. It's looking now as like the Fed may want to push it out to maybe June. With tomorrow, what's going to be more important than just saying that the rates left rates unchanged is the fact that we want to hear Powell say that as if we continue to see progress on inflation, then we can expect to see rate cuts later in the year. They don't want to be overly aggressive on that. I think we talked about that a couple weeks ago, where I believe it was Fed chief. I think his name was Burns, and he actually went in inflation back in the 80s. They moved up. He cut rates, and then as he started to cut rates, if the interest rates inflation started to go higher. And at that stage, they had to really start raising rates a lot, and it caused some problems for the market. And they certainly want to avoid that. And that's what we want to kind of keep an eye on. That's why they don't want to just come out there and say, okay, well, things are going good and inflation's coming down, we're going to change it. We did see crude oil prices rise again. That's they're actually up close to the level where they were in the 1st of December. So we want to kind of watch that. We had some Americans get killed this week from, I guess, from some of the drones and all, the Red Sea. I'm surprised that the oil hasn't jumped on that type of thing. But right today it was down about 50 cents. But that's something you want to watch if they have to continue or shut down the Red Sea. Some analysts are worried that that will cause pickup in inflation. So we'll kind of watch how that's going. As far as sectors go, we saw the energy sector jump about 5% on the strengthened U.S. economy, but also on the fact that China was adding stimulus to their economy, which should create more demand for oil prices. After that, sectors were followed by gains in communication services and technology, both hit new all-time highs last week. So that's something to continue watch. And again, that's basically off of the Microsoft and the Meta and all these companies making new highs. So that's something we want to watch. 14-day RSI is showing that those stocks and those sectors are about as overbought as you can get. 14-day RSI was in the mid 70s, which is the most overbought those sectors have been since the end of July in the summer when the market stopped out. So that's just something that these stocks are kind of priced for perfection right now, and we want to make sure that so that's something you want to buy. It's kind of hard to jump into some of these stocks, even if they come out with great earnings. You may want to you probably don't want to chase them higher if they do pop up, because at some point you're going to see some of these professionals and stuff take some gains off of that. As far as the weak sectors go, consumer discretionary was the weakest, I believe, last week. That a lot of that was due to Tesla falling down. Tesla had some pretty bad earnings. They missed top and bottom line. They did some price cuts, and when you're carrying high PE, such as that is, you're gonna when they miss, you're like I said earlier in the comments, you're gonna get hammered. That's so. Anyway, as we wrapped up last week, it was higher for the third consecutive week, higher for the 12th time in 13 weeks, and right now we're on track for a third straight month of gains. So things are looking good. Momentum still looks positive. The technical condition of the market improved during the week. We did see the major averages, post record highs, but the S&P 500 and NASDAQ were overbought by several different measures. Transport index and small cap 2000 outperformed last week. That's something that's notable because small caps were actually down 4 weeks in a row. They've traded all the way down to their 50-day moving average, and we're able to bounce off of that and then outperform last week. So hopefully we'll get a little bit of follow through with the small caps and the transports. I know some of the railroads are some of the airlines reported last week, and they were pretty strong with good guidance. And the railroads are reporting this week also, so that's good for that. Semiconductor index did end of the period down 0.8%. It's working off of its overbought condition. It's actually has surged over 45% off the October low. So of course it's going to be overbought, and that's and unfortunately when you have something surging like that, if NVIDIA or AMD tomorrow cut their guidance or trim their guidance a little bit, could see those things maybe get hit a little bit after you've had a move like that. But again, they're priced for perfection. I don't think anyone's expecting them to report weak. Underlying breadth improved during the week. Talked about that's something that traders will look at for negative divergence, where the indexes or a stock are making new highs, but you look at some AD lines, and the AD lines are moving lower as the stock's moving higher. That means you have an influx of sellers coming into the stock or the index. And we didn't see that. We actually are very close with the NYSE AD line pass up its highs from the last week of December, and it now stands just about where it was, that line in July highs. So if we can see more improvement in that, it probably means the market can move a little bit higher in through here. I did mention last week that investor sentiment is getting a little bit frothy again. Investor sentiment is getting frothy. Okay, investor sentiment once again getting a little bit frothy, though. We saw the MarketEdge Sentiment Index drop to a -5 from -3. Retail investors are kind of getting back to their historical average of 37.5% of being bullish. Professionals, though, are kind of ramping things up a little bit in here. I don't know whether because of going into earnings, or maybe they're expecting the Federal Reserve to be a little bit more dovish. Hard to tell, but they had dropped their exposure to equities down to about 53.5% about a week or so ago, and they just jumped up last week to 84%. You usually don't see big swings like that magnitude. So that's kind of a little bit surprising. On the other side, we saw the percentage of bearish investment advisors slide all the way down to 17%. Only 17% of these guys are bearish, and that's just below the final 2023 reading for the fewest bears since the summer of 2021. So this is something that we'll keep looking for it. But one thing I did mention in the weekly market letter was FINRA reported a big jump in debit margin and margin accounts to 700.774 million or billion in December. That's the highest level since July 2023, also as a summer peak. So when these indicators get to, they're pushing, previous highs where the market, rolled over, you just want to pay attention to things like that. Okay, momentum wise, we jumped up 7 notches from the previous week. Again, we saw also a nice improvement in the AD lines. We still have way more industry groups strong or improving than we have weak or deteriorating. We're down to 70 strong or improving from 21. I mean, from 88, I think, just about 2 or 3 weeks ago. So things look good in here. We have a lot of information coming out this week that's to cause a pickup in volatility. And we have a lot of jobs reports coming out for January. We have the government's the ADP report, I think, is coming out on Wednesday. We have the government's job report coming out on Friday. Again, we get Wednesday, we get the OMC meeting announcement. And like I say, a lot of this stuff, that those announcements, plus the fact that big cap tech stocks are finally, announcing their earnings, cause some volatility going forward. So, but things look good at this stage, and I think we probably can. We're going to have to, rein in some of the overbought indicators of the market, but that can be occur by moving sideways or maybe having a minor pullback, 3, 4, 5%.
Well, it sounds like it's going to be a key week for the market with big cap tech earnings and the FOMC meeting. Is there anything in particular that our subscribers should do ahead of all this data out during the week?
Good question. What you want to do in a week like this, where you have so much going on, is you want to maintain your long-term goals, and that is that some of these things could move the market. Maybe we get some news out that market jumps up 300 points or down 300 points. We've bounced off of those October lows. We're in a period where more than likely we're going to see Federal Reserve start to begin to announce that they're going to be cutting rates, which will make equities even more attractive with that. What I don't want you to do is say you get Microsoft and maybe one analyst says, "Hey, it's price perfection. It's had a big move. We're going to downgrade it to a market performer." Something like that, and the stock goes down 4 or 5 or 6, $7, and you decide you're going to sell it. Just remember that's you don't want to sell yourself short on these things. Keep your longer term goals in mind, and remember that what's going on with Nvidia, what's going on with Microsoft, and some of these companies is going to be pretty big here towards the end of the year, and these minor blips are probably more of a chance to, maybe if you have 150 shares, maybe you add 25 on a big pullback, even though it's higher than where you bought it. One of the worst things that people do is they sell their winners and they hold on to their losers, and that's not how you make money in the market. You want to you let your winners ride, and these companies that have a long. If you look at the charts and they got a 45-degree angle up to the right hand corner of the chart, those are the ones you want to hold on to.
All right, so hold on to the stocks with a 45-degree angle to the upside. Got it. All right, so we are actually running out of time for this week, David. Is there anything else that you would like to add before we let you go?
No, I don't see anything. Again, you want to pay attention to all the stuff that's going on. More important would be on Wednesday, you want to listen to Fed Chair Powell's comments. What you want to hear is that the committee sees progress on inflation, and that they're going to be open to rate cuts, later on in the year. You don't want to have them say that, hey, things are looking bad or things are getting strong, and rate cuts are off the table. He's not going to do that. You don't want to say that Fed's politically biased, but during an election year, rarely are you going to see the Federal Reserve come in and try to, and upset the apple cart here in the markets. They're usually, they're talking to whoever the sitting president is, and the sitting president pretty much is telling them, whatever you do, don't knock this market down. And that's so you can expect the market to kind of go. One other thing I did bring up on Friday is that, with the S&P 500 making a new high here, I don't know, last week or the week before, that has happened, I believe, 14 times, where it's taken over a year from a high to when it made the next high. And if it was 13 times, I think 12 of the times it was up that year. And when that happens, on average, the market's up by 10% of that time. So that's something to remember. I wouldn't get too bearish on this market at this point, and I would use it probably. And even our cycles are expected to be bottoming out here, if they haven't already bottomed out any time. And around here. So we should be setting a lot of those things, looking for more higher markets here going forward.
Okay, wow, that is extremely helpful information about the S&P 500 and duly noted. However, we have to cut it short because our founder will not stop calling David Blake. So apparently he has something really important to say. So we are actually going to cut this week's episode a little bit short. Thank you to everyone for listening in, and you guys can catch us again next week.